We've got Stephen Hines, who's joining in, Chief Market Strategist at AxiCorp, on the phone line. Good to have you on board, Stephen. Let's get in your view first up as to how we are. We also have actually with us Tony Greer, who is joining in, founder TG Marco. Thank you so much, gentlemen, for being with us. Stephen, I'm going to come to you first. As of now, we're accustomed to those awfully wild swings with the equity markets across the globe. But let's talk about one of the factors at play, and that without a doubt is the looming recession that now is very much imminent at a time like this. You have reports indicating that this is worse than the mild recessions of 1991 to 2001.
Certainly looking that way. If you start to factor in a lot of the economic data that we've seen come out, it has been quite much below the forecasted results. And if you consider this, even to the most recent meltdown we've had in the markets in 2008, when we had the Shearson and Lehman incident, what's really the problem here is that people aren't going out shopping, people aren't using taxis, people aren't going to restaurants. These are the base things that were continuing on. Life was carrying on back then. Life has come to a full standstill. So I can only imagine that the data coming out is going to be dramatically worse than even what the forecasters have predicted. So I think the worst is yet to come in that regard.
Okay, Tony, morning from Mumbai. What's your view? We were waiting for the central banks to act, but now worries about whether this is just going to be enough to keep some money in people's pockets, but not enough to prevent a recession.
Yeah, it seems like with the level of shutdown that we're going to be experiencing, that a recession or something like it is going to be happening. How quickly we recover from it is going to be determined by how deeply the disease cuts here in the United States in terms of a death toll. I don't think that we have, any handle on what that's going to be yet. And I feel like if we, at least I can be optimistic, if we can come in somewhere around the lower range of what has been expected, maybe the markets can hold in here. But the problem is we've unwound a lot of, we're beginning to unwind a lot of excesses that have been taking place and a lot of market distortions that have been taking place. So this move could continue in the securities markets a little bit beyond what the economy might bring. So I'm definitely concerned.
And, Tony, one wonders, because we know this is a medical emergency, but would it really take stimulus to try and pump back the economy? Or are there other ways? India, for instance, we've not had the central bank cut rates or the government announce any stimulus. Could that be the other option? Let the economy take its slow grind lower, let the poison get out of the system, but in a natural course.
It's certainly an option. It doesn't seem to be an option that we take here in the United States with the Federal Reserve, literally emptying its toolkit into, their first response to this virus. So they're clearly trying to get way out ahead of something that they anticipate being extremely severe. Let's hope that they're overreacting. Let's hope maybe the media is overreacting. And, let's hope that this thing can be contained and we can get markets back into functional mode, because if we continue with a crisis of confidence and the market participants don't accept, the terms of the Federal Reserve and other central banks, then we're going to have a bigger problem on our hands.
Stephen, what is the investor approach? Because, just digging out notes from this morning, you've got Goldman saying that recession is going to be front-ended. You've got Morgan Stanley saying global growth is going to dip to sub 1%. Gunluck saying that, it's time to remain liquid. US recession is here. So as an investor, what is it that you do? Because most asset classes are coming off, be it crude, be it precious metals, and equities also.
I think the central banks moving to the lower bounds here at zero is actually good in the sense it's going to provide, they're actually unshackled here, and it's going to provide governments to move more on the stimulus package. Central banks QE will become significantly more important, but getting back to the question, how do we position for risk? I think we look at those countries that were out in front taking not only stimulus measures, but proactive containment measures. That would be China, Korea, I would also include New Zealand and probably Taiwan have taken very proactive measures. I think once the lights start turning back on in China, I think you'll start to see flows back into that economy again. That's probably the focus that the market's going to take. However, right now, most people are sitting at home. We're all thinking about the same thing, and that's our families. You know, until we can move out of this situation right now and start to really focus back on the markets 100%, I think risk remains light in the markets right now.
I want to get a sense from you on, what you're anticipating with regards to the market action, even if we do have liquidity being pumped in from the central banks, given the fear right now. Saw a minor bounce yesterday. Today, again, the futures are looking dicey. We've hit unprecedented lows. What's the strategy?
From my perspective, the strategy is to keep my eyes and ears wide open right now. The most tenuous thing I think that we're dealing with in the markets is watching what's going on at the repo window. And, that's been on, a high alert on everyone's radar screen since September. We're still seeing enormous amounts of money clearing through there. And there's really, it kind of rhymes with a blow up that it looks like is going on in the markets. So I'm really, I'm on the lookout for companies with strong balance sheets that might be able to withstand a prolonged economic turndown. You want to stay away from the companies with, that are a high yield risk, because obviously cash flow is going to become a problem no matter how, severe or less severe the virus strikes. We're going to have major cash flow problems at companies that probably can't afford it. So if you stick to, companies that are going to come back when, this virus passes through and that have a strong balance sheet, it can at least withstand the slowdown, then I think at least you're looking in the right place. Whether the timing is right now, I still think that if you're putting money in the stock market right now, it's probably in for a lot of motion sickness before the outcome is determined. So I would still prefer to wait until volatility at least subsides by half, with the VIX cutting itself in half from 80 to 40 before I would even consider dipping my toe into the markets. I just think it's too treacherous right now. We haven't decided what the downside could be. Since we don't know what the virus impact is going to be, it's very treacherous.
Right. Tony, Stephen, both of you, thank you so much for taking the time out and joining in today for this quick chat.